another person. Okay. Firstly, welcome everyone to our first event of semester 2. Obviously, semester started today. Hope you had a lovely Christmas holiday, a restful break. I know most of you probably had exams or deadlines, so I hope they all went well. This is the first of 6 sessions that we're going to be running this semester for Investing 101. And as you will have seen, hopefully by our email or on social media or the WhatsApp group, if you attend all 6 live, then you will be eligible for a certificate at the end, which is something great, you know, to be able to put on your CV or your LinkedIn or whatever. It's just something cool to have. Henry's going to be running the majority of them as normal.
Hey guys.
And they're going to kind of follow a course to help you carry on building your investing skills. Anything that was covered last semester, you can access on our YouTube channel, which I will link in the chat later on. And yeah, look, we've got so much planned for you. I'm going to tell you more about it after Henry's given his presentation. But thank you for spending your evening with us. And Henry, without further ado, feel free to get started.
Cheers, David. And a very warm welcome to you guys. It's great to see so many of you. Great to see so many faces as well and participants. This is a massive uptick from last time, so welcome. Okay, so today we're going to be talking about how to find a great company. This is going to be the more qualitative side of the quantitative stuff we talked a little bit about last term. You remember last term, Amrit and I ran sessions on ratios. There was a bit on macroeconomics. This is more thinking about how to find a good business from a qualitative point of view, how we can analyze that business model to work out if it's well positioned in the market. Okay, this is just a welcome. I'd be interested to know, are there many people here that haven't been to a session before? Is there anyone here who's completely new?
Just put your thumbs up on here, or even just turn on your mic and say, yeah, quite a couple of thumbs up. That's great to see. Welcome. Really
that's
nice.
That's really good. Yeah, I will say that very warm welcome. This content shouldn't be too technically difficult, hence the name 101. But we have got all of our sessions from term 1 on YouTube if you want to go ahead and catch up. Okay, so here we go. What's on today? So business economics. We're going to talk about a concept called economic moats, which I will explain very shortly. We're going to go through Morningstar's 5 moat framework, which is basically it's a framework they use to find these good companies with this mysterious name, economic moats. And then what we're going to do is we're going to hand over to Ethan, and he's going to lead a general discussion on GameStop. We're just going to open the floor and kind of all discuss that. I've actually got the book right here because I was finalizing the presentation today. It's Why Moats Matter. David's probably mentioned this, but every week we're going to be doing a new book that you can win. And what I've done is I've matched up the books that people can win to the sessions. It's all going to be randomized, but anyone who attends an Investing 101 session is in for a chance of winning an investing book. Okay, so this is a disclaimer. I put this on every presentation, but this is not financial advice, not a financial advisor. We are here to educate you. Right, what is an economic moat? So I'm just going to put you guys over there. Okay, so an economic moat, historically, moats were a protective barrier against entry to a castle. That's where the analogy came from. Warren Buffett came up with this analogy. Does anybody know what castle that is, out of interest? That's quite an obscure question. It's Bodyham Castle in East Sussex. So in business terms, what does this mean? An economic moat is effectively a competitive advantage a company has, which prevents new companies from coming in and taking market share. So the idea is the moat is the protective aspect of the business. That's where the analogy comes from. So why are these competitive advantages important? They're important because they help companies to avoid a situation of perfect competition, where if there is any chance of making profit, new companies will constantly enter. They will constantly erode the profits of the existing companies and basically have a load of companies competing on price alone. Obviously, price of the product is usually a pretty important factor when determining which businesses get market share. But for some industries, price is overwhelming. And there are other industries, the ones with economic moats, where price isn't so much a factor. And there are other factors with the business economics that come into play. I just wanted to give you an example here. So quite interestingly, so supermarkets in the UK, they don't typically have wide economic moats. most people go to the supermarket are thinking about it from a price perspective. Not all the time. There might be certain products you like at certain supermarkets, but for the most part, all else being equal, people try and get their foods at the best possible deal. If Tesco raised all of their prices to £5 tomorrow, we'd all be going to an alternative supermarket, which is quite interesting. So you can see here, it's a shame I couldn't find more accurate data, but I did manage to find a quarter of a recent year. You can see the supermarket growth in the UK. And as I mentioned, these supermarkets, they don't typically have wide competitive advantages, but Aldi and Lidl, they sort of did have a competitive advantage across very, very, very efficient business model. And what it allows them to do is it allows them to effectively buy stuff in bulk, and that allows them to be very, very cheap in terms of what they're selling per unit. And yeah, it makes supermarkets cheap. Supermarkets, they ultimately compete on price, and therefore Aldi and Lidl have really grown their market share in the UK. Okay, so how do you know if a company has an economic moat? So the most important rhetorical question you want to be asking yourself is, can the business raise prices without losing market share? Are there other factors that are bringing their customers in rather than competing on price alone? And it's quite difficult to think about in isolation. So I just wanted to show you two quantitative measures that I often use for kind of picking apart the businesses and assessing if they've got this economic moat. The first one is operating profit margin. This is also Ebit, or interest before earnings and tax. And if you think about what it is when a business has a very, very high margin, it means for every dollar of turnover, a lot of that is falling through to operating profit. So they're not having to spend much to produce that turnover. They're not having to spend much in operating costs, and hence a lot of it falls to that Ebit line of the income statement. The other thing is return on capital employed. I can explain this very simply by saying you've got your operating profit, how much is in the business that is kind of the business owns in order to produce that operating profit. It's the total assets minus the current liabilities or the short-term liabilities. I just wanted to go through those two quantitative metrics quickly because whilst there are a lot to try and find economic moats, these are two that I found very, very useful over my time of investing. And just to give you kind of a heads up of what we're going to be talking about over the next 5 slides, Morningstar, they are a very, very reputable American research firm. They're very, very good at researching stocks, and their speciality is trying to find these economic moats. So it's not only the quantitative side, they're very, very good at the qualitative business analytical side of things. And it's great. They write books like this. They write many books. Pat Dorsey has written countless. The Little Book That Builds Wealth, 5 Successful Rules of Stock Investing. Josh Peters has written the Dividend Playbook, who's kind of the head of the income side of things. But anyway, they have a framework of 5 different categories where they try and identify these competitive advantages: cost advantages, switching costs, intangibles, efficient scale, and the network effect. And that's what we're going to go through in the next 5 slides. Guys, have you got anything to add, or do we have any questions?
I was just going to say very quickly that anything there that you've already covered in terms of assets, liabilities, we actually covered in semester 1 for anyone that wasn't with us then. And you can check out all that kind of stuff on our YouTube channel, all our previous sessions. So if none of this is making sense to you, or you feel like you've kind of missed out, don't worry, because it is all there. And one other thing to add that isn't exactly related to what you just said, Henry, but in terms of the book giveaway that we're going to be doing this session, you will need to be staying right until the end of Henry's presentation when we do the giveaway to make sure that you're in the chance of winning. So yeah, feel free to carry on, and any questions, just put them in the chat, or you can chat to me privately, and I'll get that question across to Henry.
Sweet. Okay, cool. I will, as I said, there's not many slides in this presentation, so what I'm going to be doing is I'll just be stopping after each one, and we can have a little discussion. Okay, so let's go through the first one of these. Cost advantages. Right, so this is pretty intuitive to understand. It is what it says on the tin. A company has a cost advantage when their unit cost is lower than all of their competitors. This can be from multiple things, but usually it's some kind of more efficient process, a superior location in terms of the example I'm about to give. access to some unique asset that's something somebody else doesn't have, something that makes the business model incredibly efficient. It might be Southwest Airlines running older airplanes, which it doesn't have to pay the same high fees that it has to lease. It could be Aldi and Lidl, as I said. Basically, what Aldi and Lidl do, the main reason why they're so cheap is they will buy the bare essential stock in bulk. Obviously, when you buy bulk from a wholesaler, it's cheaper per unit cost, you know, because if we order double the amount of stock, we can get a slightly cheaper price per unit of stock. That's what Aldi and Lidl do. They order the real basics in bulk. They're able to have a lower unit cost, and then that's reflected in the lower cost for the consumer. That's why they're seeing growing market share, because these supermarkets, they compete primarily on price. So the example that I wanted to give here is actually a company that I'm invested in at the moment. It's Kirkland Lake Gold. So Kirkland Lake Gold, they're a gold miner. Gold mining is a pretty simple and intuitive business model. You find a site, you mine gold out of the ground, you transport the gold, and then you sell it. And it's interesting that the two metrics I last mentioned in the last slide, return on capital employed and EBIT margin, you can see that Kirkland has done very, very well compared to the other precious metals that we're comparing it, particularly for return on capital employed. That's what these stocks are ranked by. They're ranked by return on capital employed. 44, it's almost double any other stock. That's absolutely crazy. The reason why we're able to see a higher return on capital employed for something like Kirkland is the grade of their gold that's mined out the ground is much higher than the average gold miner. Effectively, what that means is, imagine you're mining a ton of rock. G over T stands for grams per ton. If you're mining a ton of rock that contains gold, the world average amount of grams you're going to find in that ton of gold is about 4 to 6. Kirkland's gold mines are very, very high grade gold. So that's about that. They range from 15 to 30. One of their Australian mines, Fosterville, was mining about 40 grams per ton, which is absolutely crazy. And what this allows them to do is it's effectively the unique asset part of these cost advantages, right? They have this unique asset, which is high grade gold when everybody else. And if you think about it, if you're mining, you know, if what you're selling is more valuable for every ton because there's more gold, then that means that your return on capital employed is going to be much higher because you need much less machinery to mine a ton of gold than some of these other competitors. So that was the first one. Has anyone got any questions on cost advantages?
We actually had a question, which I think was related more to your previous slide, which is, what is EBIT? So if you could just,
sure.
If you go over that maybe more simply.
Of course. Okay. So, one thing I'll explain. EBIT is synonymous with operating profit. They're the same thing. Okay, so if you think about an income statement, you've got the company's turnover or the company's revenue coming in. You then have the cost it takes the company to make that goods. Just the raw cost it takes to sell those goods. It's usually called the cost of goods sold. Then you get your gross profit. So that minus revenue minus the cost of goods sold is your gross profit. Not usually particularly useful because cost of goods sold is very, very subjective. Basically, after that gross profit, you have all of the administrative, research and development factors taken out of it, and you get something called EBIT. It's earnings before interest and tax. So it's basically the profit of the business, but before interest and before tax. The before interest part of it means that if a company is taken on debt, it's done that through corporate bonds. It has to pay interest on those bonds, and that is in the income statement. It's before any of that. So that's effectively what EBIT is. It's pretty much the operating profit. The reason why I like to use it so much is that it's probably the most difficult measure of profit to manipulate, for accountants to manipulate. It's very, very easy to manipulate gross profit just because the cost of goods sold is so subjective. It can be quite easy to manipulate net profit, although it's more difficult through taxes and where companies are paying taxes. But EBIT or operating profit, it's usually a very consistent trend over time, and that's why I use it. Let me know if that answers your question. If not, I can explain more.
So yeah, cheers, Henry. And we have had one more. if that's all right, if you've got time for
Yeah,
that.
yeah, of course.
Which is why would some supermarkets like Lidl and Aldi choose to, I guess, buy through wholesale, but others wouldn't?
That's a really good question. I'm not sure if I can answer that accurately. If anybody else wants to take a stab at it, you can go ahead.
Well, to be honest, I would just assume that most supermarkets actually buy through wholesale. Just some get better deals than others on the items in the bulk that they're buying.
Right. Yeah.
And I think,
If we're talking major supermarkets, yeah. I mean, there's some exception if it's like the corner shop around the street, but
sure, but I think
yeah,
Lidl and Aldi probably have like an unbelievable supply chain,
yeah,
and really, really good, I guess, really good deals.
exactly. That's the way that it works. Like if you're approaching wholesalers, right, the way that you're going to get a better, because the reason why Lidl and Aldi can be so cheap is because obviously it's not that they have really, really low margins and they're just selling things really, really cheap. It's that their costs are also cheaper. That's why they're able to do it. The way you're going to get cheaper costs or cheaper purchases from a wholesaler, the main way you're going to do that is buying in bulk. If David and I were both going to go and buy 5,000 eggs for, I don't know, 10p an egg, and I said, actually, what if I buy 10,000? The wholesaler's going to go, great, we're going to sell 10,000 eggs. They might give me a deal for then 8p an egg. So then my cost per egg is 20% lower. And that can be then reflected in the consumer's lower price because Aldi and Lidl have the cost base to do that. And that's why they've been able to charge so cheap for food.
Yeah, we've actually had a couple of comments about that in the chat. Max has said that other supermarkets have multiple brands, whereas Aldi's only Aldi own brand. And Amy has said that there are also more luxury organic products, maybe at other supermarkets, so it's higher markup.
That's a good point, actually. I remember an interesting story about that. I remember I used to go to buy Cadbury's chocolate from Tesco as a kid, just the local Tesco. Usually about £1 for 100 grams. It's a bit more expensive now. And I remember when the Sainsbury's Basics came out, the Sainsbury's own chocolate, same weight, say 100 grams of chocolate, and it was 27 pence. It was crazy. £1 versus 27 pence. And that is a trend we have seen quite a lot, And again, it shows you the lack of competitive advantage if you don't have a strong brands to back it up. Like how many people are buying like Fairy Liquid washing up, which I think is Unilever, I think, when you can buy Sainsbury's own or Co-op's own. And you're right, like Aldi do a lot of that, and it makes it much, much cheaper. It's the no frills, like, why are we going to buy like McVitie's biscuits when they're like wholesaling at like 80p if we can produce a pack of our own for 20p? You're right, that is much, much cheaper.
Yep, it's a great point. And then the final one that we have here, just before I let you move on, is from Sam, and he said that Aldi's food tends to go off a lot quicker than its competitors, so they might buy food with a much quicker expiry date. Which is, yeah, so I think that's a really, really interesting point. So thanks, Sam. But yeah, sorry for
testing. David, I can't hear you. I don't know if anybody else can.
Yeah, sorry. I said sorry for like stopping you on your trail. Feel free to carry on with your second point.
Yeah, no worries. We've got a fair amount of time for questions on this one, just because there aren't many slides. It's literally we're going through these 5 different types of moat, and then we're going to talk on GameStop. Okay, right. Let's move on to number 2, is switching costs. Okay, so these are expenses that would occur when, let me just move the thing so I can read the thing. Yeah, when there's a cost to change from one provider to another. So effectively, you want to be thinking about what is it costing the consumer to change and what are the benefits of changing. So for example, like our utility bills, right? Like we might be able to save £1 if we switch to the cheapest deal every year, but most of us can't be bothered, particularly when we're on hold for like 40 minutes. We have to go round and round and round, and then there's some cancellation fee. The switching costs are incredibly high, and this makes utility companies have a big competitive advantage. It's obviously very, very annoying because they're not the greatest to deal with at all. Another example is banks. You might see another bank have like a higher savings rate by like 0.1%, but the average consumer isn't going to change just like that because your bank is so heavily integrated into your life, and it's so much effort to change and set up a new one that it's often not worth the bother. This is what this quote means here time is money and money is time. Don't take that completely literally. But in the context of switching costs, it's true, right? Like you have to weigh up, if it's not cheaper to stay with the same person who you're with, what is it in terms of time? It might be £1 cheaper a year to switch to another provider, but if it's going to cost 2-3 hours of your time and a load of frustration, a lot of people don't really bother. So that's the kind of consumer example. I wanted to go through Microsoft because they have had very powerful switching costs over the years. So Microsoft, very, very successful company. As you guys probably know, in the early 2000s, it was the largest company in the world. And Bill Gates was the richest man in the world, on and off with Warren Buffett, but he was pretty much at the top. And they created these great programs that businesses used. They created Windows and they created Microsoft Office and had all these great products, and businesses used them and people got used to using them. Imagine if somebody else came out with a product that was similar, but obviously, when it changes, it's hard to get your head around, right? Like these programs, they take time to learn. It takes time to hire the software engineers and IT guys if anything goes wrong. And it's not just like we could change to another program just like that. So Microsoft had a massive economic moat around switching costs. Businesses use Microsoft and Windows, therefore, boom, they have to keep using Microsoft and Windows because it's very, very hard to change and be like, right, we're going to get all of our employees used to a different program. It's quite interesting, actually, because obviously people know that Apple are very, very big into computers now. And if you look at where the market has shifted in the consumer space or in the personal computer space, Apple have done really well at gaining market share. But if you look at businesses, besides the real creative industries, if you look at the core businesses across the world, the vast majority of them still use Windows and Microsoft. And I think that is because this huge switching cost is still prevalent. It just goes on year after year after year. And also a lot of people know that Microsoft, that they didn't lose a lot of their business, but they failed to find innovation for a bit of time in kind of the 2010, 11, 12, 13, 14. They got a really good new CEO, Satya Nadella, in 2014. And now they've done really, really well in the cloud market. It's the same thing, right? So Azure is their cloud provider. It's the same kind of thing, right? Like if businesses all decide to go on the cloud with Azure, and they probably will because Microsoft is a big trusted name and a big tech company. And obviously you want someone ultra trustworthy when you're storing your data. And people are used to using Azure, all the things on there. It's going to be very, very hard to say, right, let's go to AWS or let's go to what IBM are trying to do with the cloud because it's much cheaper. And you can, again, look at the metrics that I mentioned. You can see this in the Ebit margin and the return on capital employed. You had very, very good margins, very good return on capital employed. To be fair, these are good throughout, but you can see there's a decrease in kind of the late 2008, 2009, early teens, when Microsoft, they weren't really dominating anything new. And now Azure is really, really coming to front and the EBIT margin is going up. The return on capital employed is going up. And I would also argue their moat around switching costs are going up. Anything to add, guys? Any questions?
We haven't got any in the chat, but I've actually got a question for you.
Okay, here we go.
How much overlap do you think there is between switching costs and brand loyalty?
A fair amount, 100% a fair amount. And I would say that that is a factor in Microsoft's cloud. I think that's going to be a very big factor in Microsoft cloud because it's about safety. And if you have a safe brand, it's going to help a lot. Don't quote me on this. I am not an expert in the cloud at all. But from what I know, I have an inkling that Azure might do slightly better than AWS, which is Amazon's cloud provider. If there are any tech nerds in the audience, which I'm sure there are, please feel free to share your opinion. But my thesis on this would be, if I was a business owner, I would trust a tech company the most with the cloud and online storage compared to somebody who's more diversified and trying to tackle the globe and tackle the whole marketplace and was originally a massive data company, an online retailer, et cetera, et cetera. I would trust Microsoft the most with this. And I would trust Microsoft much more than some startup company who hasn't got many customers, because Microsoft is established. It's been there for years and years. Businesses are familiar with the company. They've been using it. They've got the proven track record, et cetera, et cetera. So I would say that brand loyalty would be a very big factor here. Although I would also say that if the brand loyalty goes away and you don't have another form of switching costs, then the switching cost is also going to go away pretty quickly. I.e., if there's one data breach on the cloud, that could mess up a company completely. If there's just one data breach and someone's data gets lost or some files get corrupted, even for one company, that could destroy the whole entire brand. Although with the clouds, as I mentioned, there are other switching costs beside the brand, i.e. the effort it would have to be to change from one cloud provider to another.
Great answer. We've had some nice comments in here in the comment section from George, who says loyalty can shift quick, as I'm sure you saw last month with WhatsApp, but overall it's a good buffer. And also from Alex, who said, I've used cloud quite a bit and would only trust Google Cloud and Azure, but it can be a lot of effort to move things over to another cloud provider, which I agree with. It's the same. I'm happy you brought up the example of Apple, because I was going to use it from a consumer point of view. If you're someone that, for example, over the years has had like an iPod Touch, an iPhone, an iPad, a MacBook Pro, if you're fortunate enough to have been in that situation, and then Samsung come along with this amazing new Android phone, how tempted are you going to be to switch it? Arguably, probably not, because there's a switching cost. You're also loyal to Apple, and I think it's a really interesting economic moat. Definitely.
That's a good point, actually. I think in the book, actually, the main example, or one of the main examples I use of switching costs, is Apple. For me, like a big switching cost of that would be just like I do a lot of photos and videos and video editing, right? And just like the stuff on my phone, with my phone's right here, just to be able to like link it up to my laptop so incredibly easily and just go boom and just have everything there. And for my computer to be my phone and my phone to be my computer, yeah, the switching costs are high. And it's similar with Microsoft Windows and Microsoft Office, right? Like when you know an operating system really, really well, like who cares? Like you use your phone every day. Like it will be a lot of incentive in order to change providers from Apple to Samsung.
Yeah, well, Emma has just said in the comments that they made it easier to switch over to Android from Apple, and there's a specific cable to transfer files over, which is interesting. I didn't know that. But I do agree, from a personal point of view, you can click AirDrop on a photo on your iPhone, go straight to laptop, go straight to any other device, and iCloud as well. But yeah, sorry to get you sidetracked on that again.
No, man, no problem. I mean, I really do encourage discussions on this because it's what gets people thinking, compared to just me blurting out my opinion for an hour. It's really important to encourage and all kind of learn from each other.
Sure. And just before you move on, can I say how amazing it is? We've got so many new faces and names in this chat tonight.
It's really good. Yeah.
It's really, really nice to see. I don't know if you guys have just joined UOB for semester 2 or if you just heard about us as a society, but thank you so much. It is really, really nice to see. Very refreshing. Anyway, sorry.
Right, here we go. So number 3 was, let me see if I can remember, intangible assets. Yeah, intangibles. Okay, so again, I think all of this is quite intuitive, but let me know if you guys don't think so. But intangible assets are basically assets that aren't tangible, right? You can't touch them or feel them. They're not a location-based. They're not a hard asset. They include things like patents, brands, research and development, and anything that's hard to quantify. So pharmaceuticals are very, very big on this. If anybody knows a patent lawyer in your personal life, chances are they're incredibly rich. Why are they incredibly rich? Because companies will pay a lot of money to like hack patents or try and get rid of patents. Pharmaceutical companies, they'll get a drug approved in their phase 3 trial, and then they'll try and put a patent on it. And basically that allows them to sell the drug exclusively for an extended period of time. That gives them a huge economic moat, right? Because they're the only person that can sell this drug for an exclusive amount of time. But what other companies will do is they will hire patent lawyers. They'll pay them a lot of money to try and hack the patent and get rid of the patent. It's all incredibly complicated stuff. But yeah, that's basically how that works. And also a lot of pharma companies have competitive advantages over their research and development process, whether that's just a team or their superior scientific technology or whatever happens to be. But brands are probably the most common one that you will see in everyday life. And I'd be interested to hear people's thoughts on these brands, but I've kind of highlighted below some of the brands that I think have an economic moat. So the key question to kind of ask is just like, would you pay extra if it kind of came from this company? Do your like eyes light up when you think of this company? Do you have positive emotions associated with these images? For example, Tesla, obviously people are really willing to pay the premium to have a Tesla electric car as opposed to an electric car made by another company. Disney is probably one of the biggest in terms of its intellectual property. Just the amount that Disney own. I think they own Discovery now, like Marvel. There's just a ridiculous amount that Disney own in terms of intellectual property. Ferrari, again, that's another automotive example. Louis Vuitton, that's like labels and high-end clothing. Coca-Cola is an interesting one. People often pay the premium over Pepsi for Coca-Cola, which I find quite interesting. I wish I could find the study, but I was reading this study once where it was actually shown that there was, if you compared it, people would rather pay extra percentages for Coca-Cola. McDonald's, a very powerful one on the more low end of the price spectrum. If anyone's ever had it when you're in a foreign country, a very foreign country, and you're starving and there's loads of weird food, and you're just like, oh, I could just kill for a McDonald's. People will be willing to pay because they have positive connotations associated with the brand, particularly children. This is the clever thing, particularly with McDonald's and Disney. They have targeted the children. These are what these two are the really old brands here, along with Coca-Cola, and obviously Ferrari is pretty old as well. But these two, they've targeted kids, which is very clever because kids are very loyal brand consumers, and through what McDonald's did with their Ronald McDonald and the Happy Meal, and obviously Disney's theme parks and intellectual property, it just keeps getting reinforced, and Disney stories, we grow up as adults, we want the children to have the same experience that we had, and the cycle just keeps going on and on and on. And that's why companies like Disney have been able to sustain such a huge brand and intellectual property loyalty for probably three generations now. Apple, we mentioned that last time, incredible brand. People will very happily pay the premium for Apple because it's the same with Samsung, right? Like, you think the technology is just more likely to work and be sustained. Amazon, they've built up a great brand through just being very customer centric and being organized with their delivery. And Tiffany. So Tiffany are a jewelers, as many of you may know. And yeah, people will happily pay a lot of extra money just to have the same necklace in a Tiffany box. Anything to add, David, or any questions?
I saw on LinkedIn, I think it was yesterday, maybe this morning, the most unbelievable post about this. And it was basically for Heinz ketchup.
Yeah.
And they sent out it was a part of a campaign, and they said to people, draw what you think ketchup looks like. And everyone drew a bottle with Heinz on it. And it just shows like the connotation. When you think ketchup, you think Heinz, and they've built that. That's I think purely intangible. But that is the economic moat. No one comes close to Heinz when it comes to ketchup. And I guess it's the same for Disney, same for McDonald's. When you think fast food anywhere in the world, it's usually McDonald's. When you think like a refreshing fizzy drink, it's usually Coke. So yeah, that's my point, Adam. Just seeing if we've got any.
Warren Buffett's favorite Coke. I was just going to say, just on that point, I was reading Morningstar's food producing reports just about food producers, and a lot of them don't have any economic moats. It's similar to the wholesale example, but they actually gave Kraft Heinz, who makes the ketchup, a wide economic moat, which I thought was very interesting.
Yeah. I'm trying to find that post on LinkedIn now, see if I can share it, because I thought it was great. And they put up the drawings of like the kids that did this all over, I guess, on billboards, which is really cool. So, and I love that you've included our society logo in there as well.
Of course.
Nice little touch. Anyway, yeah, no questions in the chat, but some really nice comments. So.
Cool. Right. Numero cuatro. Okay, efficient scale. So this one is a little bit rarer. It's not something you'll see in the average business, but it's still an important one to go through nonetheless. Morningstar, they used to have the original 4, which didn't include efficient scale, but now it does include efficient scale. So this is where you have a company serving a very limited market size, where new businesses that might be thinking of entering the market just say, let's not bother. There's just going to be no demand there. We're just not going to make any money. That's effectively what efficient scale is. It's very common among where geography is key. So think about, you have a small city, one airport is serving it fine. You go and build a new airport, there's just not going to be the demand for planes to fly in and out of that airport. Motorway service station, yeah, sure, you can have one every bloody mile on the motorway, but no one's going to use each motorway service station, or very, very, very few people, because there's just not the demand for it. No, the average person doesn't stop off for food or fill up their car for petrol that often on the motorway. So an example I found for this one was International Speedway Corp. They run like racetracks in the US, and there's usually demands for about one or two per state. But the International Spaceway Corporation, they already own a lot of these tracks, and hence new competitors, they're not really coming into the market, giving this company an economic moat over efficient scale. That's it, my man. Have we got any questions? Anything to add, guys?
No, again, still no questions. Actually, yeah, Alex said the space industry is a good example of this, I'd imagine.
Yeah, that's a really good point, actually. That is a good point. Yeah, that's true. Yeah, there's only so many. There's only so much demand. You can't have hundreds of different companies flying to space. You just can't do it. It's just not worth it. There's just not the demand there for it at the moment.
Sure. Number 5, I guess.
Number 5. Okay, I've saved my favorite till last. There you go, hey. Network effects. Okay, the reason why... Okay, let me explain what it is first. The network effect is basically where the value of a particular good or service increases when new and existing users... when more customers go to use that good or that service. So the example I've listed here is social media or Facebook. So think about Facebook. When it first started up, and Mark Zuckerberg was targeting college students to share, it wouldn't be that beneficial for most people to be on Facebook, because most other people aren't on Facebook. But when we were all growing up, why did most of us flock to Facebook as kind of our first social media platform to use? It's because everybody else was on Facebook. And hence we have this growing network effect where the more people that use a particular platform, the more and more people it benefits on that platform. And it's just this compounding, reinforcing effect on itself. Facebook, they've done exactly the same thing with Instagram. Facebook have bought Instagram 2014 or 2015, don't quote me, but it was a while ago now. It's exactly the same thing. Obviously, Instagram has a very similar business model to Facebook. And I would say probably even more so now, because Instagram has got such a portrayal about it. It's so much about self-image, and just because of the photo aspect. The network effect is so prominent just because everyone is sharing so much on there. Facebook and on WhatsApp, it's still very prominent because of the communication function of it. But Instagram particularly, just because the amount of effort everybody puts into their profiles, bam, bam, bam. And you've also got the switching cost aspect of Instagram there as well, right? Like if you've built up a massive Instagram profile with all these pictures and all these followers, it's going to take a lot to actually change to another provider. A side note, I don't know if I should be saying this right now, but I think Facebook stock is quite cheap. Opinions, it's just an opinion, but I've been doing DCFs on tech stocks, and I think Facebook, for what it is worth with the network effect and the switching cost, I think Facebook is looking quite cheap at the moment. Anyway, this is a self-reinforcing cycle because, as I mentioned, Facebook attracts a new user, and this benefits the platform for all the existing users. So that's the network effect. Very, very exciting. I mentioned eBay. eBay has a double-sided network effect. So you've got buyers and sellers. eBay is just the intermediary. The more buyers there are on eBay, the more it benefits the sellers. You have more sellers, then it benefits the more buyers. And it's just this compounding two-sided network effect that just shot eBay up to the top of e-commerce. And that is why eBay has been such a successful company for so long. It was one of the real early internet stars, and it continues to do so today. Any questions on that one?
It was just what's a DCF, but hopefully I've answered Charlie's question. If not, then feel free to ask further, but I think it's one for another time maybe.
Okay. Sure. I could say very quickly, just a DCF stands for discounted cash flow. So what I'm doing with my DCF, I'm half tempted to show you guys quickly, or let's save it. But I can one-on-one you, Charlie. But a DCF is a discounted cash flow. Basically, what I'm doing is I'm estimating the future cash flows of the business, partially based off what Facebook has done in the past, partially based on whether I think it's going to be grow its cash flow quicker in the future than it has in the past, partially looking at what the analysts think it's going to do. And then what I'm doing is I'm basically working out what that cash will be worth today, because like $100 3 years in the future is not going to be worth the same as $100 today because of opportunity cost, inflation, etc., etc. So I'm discounting it back. Then what I'm doing is I'm adding all of those cash flows up, dividing it by the amount of shares and its equity value, and then I'm getting the cash flow per share, comparing that to the current share price, and that would tell me if it's overvalued or undervalued.
Sure, I think that's everything in the chat that I can see. Charlie says very good, thank you. So thanks for that, Henry.
If you want to PM me afterwards, Charlie, you're very welcome to.
Sure. Anything else to add, Henry, before I guess we wrap up about that and maybe move on to the giveaway?
That was pretty much everything. So I would just say in summary, we discussed the concept of economic moats and given some quantitative examples. Just a reminder, that was Ebit and return on capital employed. And then we went through the 5 types. Here are the 5 types, just in case anybody didn't get that down or wants to see it again. Cost advantages, well, there they are with the examples. I would say just in terms of wider looking at this and how to kind of implement it practically, you can get quite a lot of stuff on Morningstar's website for free. You can sign up with a free account as well, and you can get some very interesting articles. And the other thing I would say is go and read in kind of the 10Q and the 10Ks, which are the annual reports and the quarterly reports of these companies. You can see a business summary. So just really think for yourself about the business and see if you can identify one of these 5 and think about if it's growing or shrinking, and then think about how this is translating to help the company's profits in the future. There's the book, Why Moats Matter. As I said, I've got it right here as well. And yeah, but good luck to the lucky winner of the book. And if anyone's got any more questions, please let me know. If not, we'll move on to GameStop.
Sure, Henry, that was brilliant. Thank you so much. And guys, if you enjoyed it, please leave your feedback in the comments below. It really helps us to know. If you're enjoying the sessions, it means a lot to Henry because he spends a lot of time putting these presentations together. So yeah, if you've enjoyed, if you have any suggestions, feedback, please put them in the comments. Looks like people are enjoying, so well done, Henry. I thought it was great. Just a couple of things.
Sorry, mate. I'm just saying next week we'll be going on to some very basic technical analysis. It will be basic, but it'll be useful and it'll be practical. Yeah, that's what we're covering next week.
Amazing. I've got a couple of things to add, but first we will let Ethan share his screen so he can show you the giveaway for the book today. So, Ethan, will it let you?
Do you want me to stop? Do you want me to stop my share, mate?
Yeah, please. That'd be great.
Yeah, you're viewing Ethan's screen. Perfect.
Okay, so what I've done, I've put all the names in this random generator. I've clicked shuffle a few times, and then yeah, let's do it. Well, congratulations, Joshua. Send David a private message, and yeah, congratulations.
Yeah,
Henry, what book is it?
It's Why Moats Matter. So I will just, this is basically, let me just tell you very quickly about the book. Well done, Joshua. So this book it's written by people at Morningstar. Heather Brilliant, who I think is very, very high up, and also Elizabeth Collins, who specializes in moats. It will go through these 5 types of moats in detail. It would talk to you about how to value these moats, work out what the trend is, and also it will break it down by every single industry and every single sector. So like you can look up, okay, let's have a look at say aerospace and defense. And you can go to glossary, you can go aerospace and defense, and it will talk to you about kind of the economic moats in that sector. So well done, Joshua. Anybody else who wants to buy the book, I think you can get this for like 12 quid on Amazon. I would really highly recommend it. It's done wonders for me in terms of just thinking about a business's competitive advantage and where it is in the marketplace.
Sure.
Okay, cool. So
Ethan, very quickly before you go on to GameStop, again, I just want to say thank you. It's amazing to see 63 of you here tonight. If you are new to the society and you've not signed up to be a member yet, we are about 3 members away from 500, which would be incredible if we can hit that. So if you've not signed up yet on the Guild website, I'm just going to send a link now to the chat, and it will allow you to sign up as a member. It's free. It takes 1 second. Copy that. And then also, if I can find it, hang on 1 second. We have a calendar that we've created, which has all our events in it. And if you like click on the link and put in your email, it will like sync it with your phone. So you'll get notifications every time we've got an event coming up, which saves you having to scroll through our social media. And yeah, really, really amazing to have a good turnout tonight, and hope to see you on Thursday for our Alpha Room session, where we'll be discussing on Thursday.
Ethan?
In the Alpha Room session, we're going to talk about the questions which I've given to my Alpha Fund analysts. You're all welcome to join and listen and participate in this discussion-based thing that I'm running. So, for example, what happens if the VIX spikes to 32? Right, technical questions that we want to identify what the effects will be on the stock market.
Amazing. Next Monday again, we've got another investing 101 led by Henry. On Tuesday, we've got the global head of JP Morgan's internal credit trading strategy. I want to get that right. He's coming to speak. I think it's 8 p.m. next Tuesday, and all events are with the same Zoom link that you used tonight. So hope to see you there. This is also the link to our WhatsApp chat if you're not in it. We're almost at full capacity on there, but if you've not got in yet, definitely get in there. And yeah, look, for the last 10 minutes that we've got, if you want to stick around, I think we're just going to discuss GameStop and what's happened in the news the last week or so. So Ethan, feel free to take it away.
Cool. So guys, I've been avidly following the story. I was actually looking at this way before this happened. I was looking at this when in August 2020, the billionaire founder of Chewy.com disclosed that he had acquired a 9% stake in the video game retailer, and it had a whole change of management, and it was all going to be like crazy good for this stock. And the stock did jump, right? It jumped, I think, 30 or 40% from its low in August. And I thought, well, it seems good. I think I've just missed out, and I'm not going to go into a failing company. And then since then we've all seen what's happened. So I'm just going to give you a very clear rundown of why it happened, and just some of my own kind of thoughts and opinions. And nothing I say is financial advice. Do not start gambling your whole inheritance away, or maintenance loan onto GameStop. Okay, so does anyone know what the fundamental reason was that GameStop was shorted? Does anyone know? Feel free to turn off your microphone and just give me a shout.
The short float is at 140%. It's like more shares than there are in the company.
That's not the fundamental. What's the fundamental reason?
Is it because they're losing market share to every other online company that sells games? They're practically useless.
They're practically useless. Well, the
They have
whole
no
point
loyalty.
of this new CEO, basically, this new
Chewy is like
this new CEO said he's going to try and make GameStop the next e-commerce Amazon. Right? We will make it the next Amazon, basically. So it was going into this digital transformation, and over lockdown, the revenue was up about 500%. Right, so it seems good, but the fundamental reason why is because the new generation games machines are offering diskless drives. Okay, so why do you need to go into a store and buy a disc if the new next generation games machine doesn't even have a drive? Yeah, that's the fundamental reason why all these hedge funds thought GameStop's done. We don't want to see game. How many games in the UK do you see anymore? Right, I don't know about you, but all my local game stores, they're all gone. Okay, so they just thought this is going to happen in America. Okay, and obviously people took a contrarian perspective, and one of those people was Michael Burry, who was represented in Big Short, and he thought these places are going to stay open because of discs. Okay, so you can take the other side of the trade, and that's what he did. I believe he was up 1,500% from his position, which he opened in, I think, 2018, like a long time ago. Okay, but all you guys are talking about is this short squeeze. Okay, so let me talk about, before even what shorting is, okay, why was there this short squeeze? So this huge hedge fund called Melvin Capital, okay, they are the creme de la creme of hedge funds, okay? And if you can't, give your money to Melvin Capital, you can give your money to loads of other hedge funds around the world, around the USA, which are more than happy to take your money, maybe for a slight lower fee. But lots of those hedge funds actually copy the Melvin Capital trades. Okay, the people who work at Melvin Capital are the best in the business. So the reason why the stock was shorted 138, 140% more than what were available is because everyone is just copying the big fish in the sea. Everyone is copying Melvin Capital. Okay, and you need to think, before I go into what shorting is, why was that allowed? Okay, why are they telling us, the retail traders who maybe $1 billion of capital or of money put into these shares, why are they blaming us when these big hedge funds are gambling basically with, look, I don't know if you know how hedge funds works, but most of the time, imagine I'm a hedge fund, okay, I've got $10 billion and I've raised that from my investors. Then I can go to the bank, in a big investment bank like Goldman Sachs, Morgan Stanley, and I can go to their global markets division. And in their global markets division sits their prime brokerage. Okay, and then in this prime brokerage division, okay, hedge fund comes to them and say, I want 10 times leverage on my capital. So what does that mean? What does 10 times leverage mean? It means they can use the bank's money and basically gamble it all the way in the stock market. So now they're trading essentially on 10 times the value which they have. Okay, so they started with 10 billion, and now they've got 100 billion stock to play with, basically. And as you can imagine, prime brokerage is risky because hedge funds can collapse and lose money, and that's why most investment banks have prime brokerage divisions, but one investment bank like the Royal Bank of Canada, big investment bank, doesn't have a prime brokerage because of the same reason. Like, it can go terribly wrong, right? So I reckon some investment banks are very pleased they don't have this division. Okay, so you need to realize that these investment banks are betting essentially tremendous amounts of money in the stock market. And the reason why it's gone so wrong is because one of the managers of these hedge funds was very confident. And usually if they tweet or say something in the press or media about, oh, this company's terrible, we think this is going to go awful, that information, that news flow pushes down the price of the share. Okay, but one crazy genius, I call him, from Wall Street Bets in Reddit, called the bluff, right? I'm pretty sure that they disclosed that they were short 138%, and he thought, okay, I can't beat them, I'm just one person, but if everyone in the 2.7 million community on Wall Street Bets comes together, right, they can drive the price up. And that's what's basically happened in GameStop. So, I don't know if you've gone on Wall Street Bets, but I have. There's great memes on there. Everyone is, like Financial Times has labeled the people on there like bros, like not intelligent people. They're just trying to make some quick buck. But I can guarantee you, some of the fundamental research which have been published on Reddit, on Wall Street Bets, it's indistinguishable from the best research from the hedge funds. Okay, and these people, the people who are leading us and leading GameStop to the moon, to Pluto, who knows where it's going to go. It's an extremely risky bet. And one of the things which not a lot of people are talking about, the market does correct itself. Hedge funds and Wall Street, right? Wall Street's very good at making money on these corrections. Okay, that it's going to go back. No one knows when. It's like saying there's going to be a big market correction in the next, maybe 6 to 12 months. When is it going to happen? Well, we know it's going to happen, but we don't know when. So if anyone does have a crystal ball, I would love them to tell me when it's going to happen. But yeah, I definitely think the question is, why is everyone going crazy at us, the retail traders, when it's really, the regulators have to look at the hedge funds and they have to think about, you caused the crisis in 2008, and the retail traders had to, regular people lost their jobs, lost their homes because of the mortgage crisis, the subprime crisis. If it were all correct, will I hold? I'm not going to give you my position because it's just my opinion. If it's correct, what the risks? If you short now, the problem. Okay, there are two options when you short a stock. Okay, I've got 2 minutes to explain this. The first option is if the price goes up, you're screwed, and that's what happened to the hedge funds. If the price goes up, okay, in theory, it can go up to the moon, it can go to Pluto, it can go anywhere, right? Go to the next galaxy if it really wants to. But in reality, you can lose everything because there's infinite losses. But if the stock goes down, you make money on the difference that you shorted it at to the price at which it's now down.
That's a really important point, mate. So sorry to jump in, but yeah, that is a really important point where, like, if you're buying a stock, the most you can lose is 100% of your money. If you short a stock and it goes up tenfold, you've not only lost all your money, but you've got to find 9 times the amount of capital to cover your position. That's what's happening with the hedge funds. Like, sure, if they buy something and it goes to zero, they've lost their money, but they're having to cover these shorts because they haven't got the cash to cover a 10x rise in GameStop.
Yeah, exactly. So I'm just going to answer some questions from chat. 1 minute left. You can buy put options, but if you buy options, they're really expensive. Okay, you have to pay to buy an option, and right now, buying a put option is really, really expensive. Okay. Next, do you think there'll be new regulation? Maybe to the hedge funds. I don't think there'll be new regulations because the rules are you cannot collude. Okay, you cannot collude as a collective to drive the price up. It's in the regulations of trading. Okay, you can't collude with everyone and say, right, everyone do it. But this is kind of what has happened. But it's happened. But let's be honest. Okay, all the hedge funds, they've all sat nicely in their gardens in the Hamptons, and they've all come together and said they have regular conversations behind closed doors. That does happen, and everyone knows that happens. Okay, and what Reddit has done, they've just done it publicly. They've done the same as what the hedge funds has done, but just publicly, and which I think takes more courage because someone could turn around and say, hey, I think you're completely wrong on that on your research, but they don't care. How high do you think GMA will go? Who knows? It's not really for me to say how high I think it will go, but it could go higher. Why don't they buy new shorts? Because if they're already losing so much money now, right? They can just it can go up. There's nothing preventing it from going up. What do you think about the hedge funds declosing last week? Do you think that's going to affect the broader market? Oh yeah, they had to reduce their positions in big companies, big blue chip companies like Apple, Tesla, and we've seen, or this morning Tesla shot up and then went back down. But Apple has definitely taken a couple of percent down from a couple of days ago because they've had to take out their position to cover the losses. And I know we're 1 minute over, so if you've got one really important question, message me privately. I hope I've given you a good sort of overview on what's happening at the moment.
Yeah, thank you so much, Ethan. I think this is definitely something that we can cover further because there's so many questions, a lot of interest in it. Obviously, it's topical. So maybe if there's time on Thursday night in our Alpha room, we can go over it a bit more in further detail. But that was a really great explanation, Ethan. And look, we get these questions every single day. What is the link to the WhatsApp chat? How can I find your YouTube channel? I've put every single link that we have in the chat right now. So take a minute, copy, paste it, make sure you're kind of following us on every single thing there. And then there shouldn't be any more questions about that. But I hope that helps you all out. And just want to say thank you again, firstly to Henry and Ethan. Great session. Really enjoyable. And I hope, and it looks like everyone felt the same way. And thank you all for coming and spending your Monday evening with us. And we hope to see you at all our events for the rest of the semester.
Gonna be a good term. Cheers, guys.
Thanks, everyone. Have a good night.